Stay tuned to see how many other videos we may have. I'll try to cut it off if it gets too long. All right, so here we go. So this is a slide that we already talked about in the lecture video. And if you haven't watched the lecture video, I highly recommend you do that. But it talks about what qualifies as a tax. All right. And so in that vein, we know that a tax is a required payment to a government agency that you get no specific benefit from. So which of these constitute a tax? Okay. So how about a payment for a driver's license? Is that a tax or a fee? Well, that is in fact not a tax. That is a fee, because you do in fact get a specific benefit. So your benefit is being able to drive legally. All right, your driver's license is the specific benefit. All right, what about a payment required by the government for a house appraisal? Well, that is also a fee and not a tax, because you do in fact receive a specific benefit. Okay. What about payment for hotel use, and it ends up to be 1% of the bill to pay for city projects? All right, well, this is a tax because city projects are not a specific benefit. All right, payment for rental car use of 3% of the bill to pay for roads. Again, this is a tax because that is not a specific benefit. All right, again, we covered this in the lecture video, but the way you calculate the tax amount is to take the tax base, normally in dollars, and multiply it by the tax rate, normally as a percent. Now, if you have a stated tax rate, that is an explicit tax. Right, so there are 3 different ways to measure tax rates, and your book talks about this, and I'm going to put the definitions and some formulas in this slide for you. So marginal tax rate is the tax on the next dollar of income. Average tax rate is your tax liability divided by your taxable income, and your effective tax rate is your tax liability divided by your total income. All right, so we saw this in our lecture video as well, right? And so we have 3 general tax rate structure examples. We have proportional, which is a flat tax. We have progressive, which is how our income tax rates are structured. And then we have regressive. And again, the only structurally regressive tax we have is Social Security. Okay? All right, so now we have kind of a discussion question. And this is Arnold and Lilly, and they've recently had a heated discussion about whether a sales tax is proportional or regressive. And Lilly argues that sales tax is regressive, and Arnold counters that sales tax is a flat tax. Who is correct? Well, the answer is they're both kind of correct. Okay? So structurally, sales tax is a flat tax because it's a set percentage regardless of how much you spend. but the impact can be argued to be regressive. And the reason that it can be argued that it's regressive is that if you make $50,000 a year and you have a family of 5 and you buy $10 worth of socks, and that sales tax rate is 5%, the impact of the tax you pay is going to be more significant than if you had a family of 5 on $500,000 of income per year and you had $10 of socks and a sales tax rate of 5%. So the argument is that the impact of the tax you pay is much larger for this family than it is for the $500,000 a year family. Now, alternately, the counter to that is if you make considerably more money, typically what happens? Well, typically you spend considerably more money. And so instead of buying $10 of socks, say they buy $100 of socks, and the sales tax rate is still 5%, but now we're talking about a much larger amount of tax being paid, and so the relative impact is the same. So the whole point to have this, to talk about this issue, is to be able to have a discussion about the impact of sales tax and how different people view sales tax differently. All right, so I'm going to stop this video right here. And so this is going to end up to be a part 1 of multiple parts because this is getting to be a rather long video. There are more practice problems in a follow-on video, so look for those. They'll all be linked to the same module. Thanks, folks.